Most people think becoming wealthy is about finding the perfect ETF. It isn't. In fact, the difference between the average investor and a successful investor usually has very little to do with the ETF they own. It has everything to do with the mistakes they avoid. The scary part? Most of these mistakes don't feel like mistakes. They feel smart, safe, even responsible. But over 20 or 30 years, they can quietly cost you hundreds of thousands of dollars. Today, I'm going to show you the 7 ETF mistakes I see over and over again. Avoid these, and you'll already be ahead of most investors. Let's start with the biggest one. Everyone says they want to invest. Very few actually begin. They're waiting for a market crash. Lower interest rates, a better economy, a bigger paycheck. The problem is there's always another reason to wait. Meanwhile, the market keeps moving. Every month you delay is one less month your money is compounding. Nobody consistently buys at the bottom. Nobody consistently sells at the top. The greatest investors weren't fortune tellers. They were consistent. Stop asking, when is the perfect time? Start asking, when can I make my next investment? That's the question that actually builds wealth. The next mistake is even more common, and ironically, it's caused by success. Have you ever noticed that everyone gets interested in an investment right after it's already gone up? A few years ago, it was clean energy, then it was ARK ETFs, then crypto. Now it's artificial intelligence. Every cycle has a new favorite. And millions of investors make the same mistake. They assume yesterday's winner will automatically become tomorrow's winner. Sometimes that's true. Most of the time, it isn't. Markets move in cycles. Leadership changes. Sectors rotate. What dominated the last decade may not dominate the next one. That's why buying an ETF simply because it had the highest return last year isn't investing. It's chasing performance. And that's one of the fastest ways to underperform. The best investors don't ask, what performed best last year? They ask, will I still want to own this 10 years from now? Long-term investing isn't about excitement. It's about conviction. It's about owning investments you understand, ones you can keep buying even when they're temporarily out of favor. If you're constantly switching from one ETF to another, you're spending more time reacting than investing. Chasing the newest trend resets your strategy, interrupts compounding, and adds another emotional decision to the pile. And ironically, you often end up buying high and selling low. If you're enjoying this kind of breakdown and actually learning something, consider subscribing. Every week we break down investing, ETFs, and long-term wealth building, without the hype. Now let's talk about a mistake almost everyone makes without even realizing it. Imagine planting an oak tree. Would you dig it up every morning just to see if it's growing? Of course not. Yet that's exactly what millions of investors do with their portfolios. Every morning they check the market. Every afternoon they check again. Every red day feels like failure. Every green day feels like success. The problem is your portfolio wasn't designed to make you rich today. It was designed to make you rich 20 years from now. Daily prices are mostly noise. Your ETF doesn't suddenly become a bad investment because it fell 2% today. And it doesn't become a great one because it went up 3% yesterday. The businesses inside your ETF are still doing what they've always done: hiring employees, selling products, developing new technologies, generating profits. The stock price changes every second. The value of the businesses changes much more slowly. Successful investors understand that difference. They focus on ownership, not daily prices. Here's something interesting. Studies have consistently shown that investors who trade less often outperform investors who trade more. Why? Because every decision creates the opportunity for a mistake. The more often you react, the more likely you are to buy high, sell low, or abandon a perfectly good strategy. Sometimes the smartest investment decision is doing absolutely nothing. Let your investments do the work. Give them time. Compound interest doesn't work in days, it works in decades. And that brings us to another mistake, one that's almost invisible, because people think it's diversification. One of the biggest myths in investing is that owning more ETFs automatically makes you more diversified. It sounds logical. If one ETF is good, 5 must be better, 10 must be even better, but that's rarely true. Let's say you own VOO. Then you buy another ETF that tracks the S&P 500. Then another large-cap US ETF. Then a growth ETF that's heavily invested in the same technology companies. You now own 4 ETFs. But do you really own 4 different investments? Not really. You're simply buying many of the same companies over and over again. Apple, Microsoft, Nvidia, Amazon, Meta, Google. The names change very little. Only the ETF ticker changes. Many investors feel diversified when in reality they've just created unnecessary overlap. More ETFs doesn't always mean less risk. Sometimes it just means more complexity. A great portfolio isn't measured by how many ETFs you own. It's measured by whether each investment has a clear purpose. Every ETF should answer one question. What job does this investment perform? Maybe one provides broad market exposure. Another focuses on international markets. Another generates dividend income. Another reduces volatility. Each one has a role. If two ETFs are doing exactly the same job, you probably don't need both. Simplicity is often underrated. Some of the most successful investors in the world built incredible wealth with just one, two, or three funds. Not because they lacked options, because they understood that complexity doesn't guarantee better returns. The goal isn't to collect ETFs. The goal is to build wealth. And sometimes, less really is more. But even if you build the perfect portfolio, there's one mistake that can quietly destroy everything. And unlike the others, this one has nothing to do with the market. Let's imagine something. You've been investing every month for years. Your portfolio has grown nicely. You finally feel like you're making progress. Then the market crashes, your portfolio drops 10%, then 20%, then 30%. Every headline says the same thing. This time is different. Experts begin predicting another financial crisis. Your friends stop investing. Some of them sell everything. Suddenly, the strategy you believed in for years starts to feel like a mistake. This is the moment that separates investors from spectators. Market crashes don't destroy wealth. Panic does. History has shown something remarkable. Every major market decline has eventually been followed by a recovery. The Great Financial Crisis, the dot-com crash, COVID, inflation, wars. Every time investors believed the market would never recover. And every time great businesses adapted, kept growing, and eventually reached new highs. The problem is, most people don't experience the recovery. They sell before it arrives. Then, they wait for the right moment to get back in. That moment rarely comes. The greatest returns in investing often happen shortly after the worst days. Miss those days, and your long-term returns can look dramatically different. That's why successful investors don't see market crashes as a signal to quit. They see them as part of the journey. Sometimes, even as an opportunity. When prices fall, your monthly investment buys more shares. And more shares today can mean significantly more wealth tomorrow. Remember, the market has never promised a smooth ride. It has only rewarded those willing to stay on it. The next mistake might be the most expensive of them all. It slowly destroys wealth without most people ever noticing. Let's do a simple thought experiment. Imagine two investors. They both invest exactly the same amount of money. They both invest for 30 years. They both earn almost identical returns. The only difference is that one investor pays higher fees. Just 1% more. 1% doesn't sound like much. Most people spend more time looking for a 1% discount on a new car than they do worrying about a 1% investment fee. But here's the difference. You pay for the car once. You pay investment fees every single year after year, decade after decade. And those fees don't just reduce your returns. They reduce the amount of money that can continue compounding, which means you're losing money on money you never had the chance to earn. That's why low-cost ETFs became so popular, not because they're exciting, but because they let you keep more of your returns. Think about it this way. If your investments grow by 10%, but fees quietly take away 1%, you didn't keep 10%. You kept 9%. And while 1% seems insignificant today, over 30 years it can mean hundreds of thousands of dollars. Money that could have stayed in your portfolio, working for you. Instead, it worked for someone else. That's why one of the smartest questions you can ask before buying any ETF is surprisingly simple. What am I paying for? If two ETFs follow almost the same strategy but one costs significantly less, that difference matters, not tomorrow, but over decades. Investing is a game of small advantages. A lower fee, a little more consistency, a few extra years invested. None of those decisions feel life-changing on their own, but together they can completely change your financial future. And that leads us to the final mistake. The one mistake that quietly causes almost every other mistake we've talked about today. Here's the biggest mistake of them all. Not choosing the wrong ETF, not buying at the wrong time, not paying slightly higher fees. The biggest mistake is investing without a plan. Without a plan, every headline changes your mind. Every market crash feels like an emergency, and every new ETF looks like the answer. One week you're buying growth, the next week you're chasing dividends. Then you're moving everything into international stocks. A month later, you're back to technology. You're always investing, but you're never making progress. Imagine trying to drive across the country without a destination. You might drive thousands of miles, burn hundreds of gallons of fuel, and still end up nowhere near where you wanted to be. Investing works exactly the same way. Your portfolio should have a purpose. Every dollar should have a reason for being there. Ask yourself 3 simple questions. What is my goal? How much risk can I realistically handle? How long can I leave this money invested? Once you answer those questions, your investment decisions become much easier. You stop reacting to the market and start following your plan. Remember, successful investors don't have fewer emotions. They simply have a system that's stronger than their emotions. And that's ultimately what creates wealth. Not predicting the next bull market, not finding the next hot ETF. Just following a simple plan year after year, decade after decade. If you forget everything else from this video, remember these 7 mistakes. Don't wait for the perfect time. Don't chase yesterday's winners. Don't check your portfolio every day. Don't confuse complexity with diversification. Don't stop investing when markets fall. Don't ignore fees. And above all, don't invest without a plan. Becoming wealthy isn't about making one brilliant decision. It's about avoiding the small mistakes that quietly steal your wealth over time. The good news is every one of these mistakes is completely avoidable. You don't need to be a financial expert. You don't need to predict the market. You simply need a plan, the discipline to follow it, and enough patience to let time do the heavy lifting. In our next video, we're going to build exactly that. A simple ETF portfolio designed to help ordinary investors build extraordinary wealth. Until then, keep investing, keep learning, and remember, a little wealth, built consistently, can become financial freedom.